So inflation isn't coming, it's already here. And many experts believe that the next wave could be even more intense. But here's the secret: not all investors suffer during inflation, some actually thrive. The problem is, most people don't know how to position their capital for rising prices and inflation. They stay in cash, get hammered in bonds, or stick with public equities like stocks that underperform in inflationary cycles. In this episode, John and I, we're going to show you how to turn inflation into an advantage and why multifamily real estate is one of the most effective hedges when it comes down to protecting yourself from inflation moving forward. John, it's great to be here with you.
Great to be here, Mark. Gosh, it feels like inflation, right? It's been like the topic du jour for the past few years post pandemic. And, the tariffs, right? There's just a lot of economic uncertainty, although things seem to be going well. And I will say, what we're seeing, there is a lot of positive out there too. But the reality is inflation is still a persistent challenge, right? And so, you nailed it. You put $1 million in the bank and it just sits there. That purchasing power is going down every single year. We're seeing turmoil in the bond markets. And, candidly, Mark, sometimes, if you look at what's going on in the stock market, more and more we're seeing just a complete divorce between the fundamentals of the company and the stock price and the stock value. And I think about a lot too, that sometimes you see the headline, oh, the S&P 500 is up X, but then you look and it was like, well, 4 stocks did that. It wasn't like every stock in the S&P 500. So not to say, I think anybody who's a savvy, prudent investor should be diversified in investing in all of these things. But the smartest investors know real estate is how you create massive long-term wealth, right? We know 90% of millionaires got that way through investing in real estate. So excited to dive in
Well,
today.
and John, just quickly with the stock market and with the fundamentals, interesting. Last night, I was looking at, I was in the mood for seeing something, with the markets, and I've seen the Big Short and some of these other shows as
Yeah.
well. And there was a show actually on, I believe it was on Apple TV, called We Crashed, and that was
Oh, yeah.
actually WeWork, and is really good. It was the whole start of, he had a vision for shared office space and then how he scaled it up. And so I was just into those types of movies. And then GameStop actually came up when I was doing some research of, okay, some movies that are, into the markets and whatnot. And so GameStop actually is a really great movie to show how much interruption one person or one hedge fund can actually do in the marketplace. And when it comes down to fundamentals, it's like fundamentals should be, that this company is performing, but the stock market is really, there's a lot about emotions, and then there's a lot of manipulation out there as well. And that movie actually was so good. You got this guy sitting in front of the computer. He's got his camera. He just presses play. He's drinking a beer, and he's talking all about this one stock that he loves. And I don't want to give it away, but the point
Yeah.
is that this guy's sitting in his basement.
Yeah.
He's making like pretty small amount of salary, and this guy actually made a like created this tidal wave where I won't go any deeper than that.
Yeah.
But it was interesting that can happen in the
Yes.
stock market, and real estate is really, you get maybe the Fed that can, impact real estate prices with, raising and lowering interest rates. But overall, real estate really is, if you do a really great job on the operations and you buy right, you can be very effective and you can have more control.
You said it right. I mean, the amount of manipulation that can take place, but with real estate, right, that ability to, on a long enough timeline, right. So what we've sometimes seen is the Fed raises rates, right, and there's a temporary blip, or maybe prices, flatten, or maybe even go down. I mean, I think, unfortunately for a lot of people, the Great Recession is still so kind of front and center in their mind, right? And it's a time in America, the only time in America, that real estate values drop nationwide. And so I think it's just important to remember that that's why we really love real estate. It's this idea that the fundamentals of land itself, it's immovable and you can't create more of it, right? And that's what gives value to real estate. Now, we could probably get into erosion or things like that, or a natural disaster can, change the dynamics of land. Say if you live close to the beach, those are extreme circumstances, right? So what I love about our deals is that, we have a 5-year hold, but we often think about a 3-year, 4-year exit. But if something were to happen and we needed to wait a year, those fundamentals always catch back up. And I think that's what I love about it. And also the ability to actually see, feel, and touch it, and the level of control you can exert over it, right? You can change your business plan, you can change your approach Where if a stock starts, maybe the CEO gets drunk one night and goes on Twitter, which has literally happened before, and says something they shouldn't say, and the stock price goes down 30% the next day. You
Yeah.
have no control, right? And so that's for me what really draws me to real estate, is the ability to have control.
For sure. So this is where inflation, if we were to simplify what inflation is, it's basically your dollars that you have in the bank account. It'll buy less moving forward. So losing purchasing power is really what it comes down to. So to kind of give you an example, you guys probably remember, inflation was up at like 8% during COVID, and pricing was going up like crazy on most things. So like, your pool, you're buying a Sea-Doo, you're buying, like all these like different, we'll call them luxury items were going like through the roof. And there was this whole like we'll just say there was like a huge demand for it. And so for the example I'm going to give is the pool. So one year it is say $100,000, and at 8% inflation, which is not that high today, but it's still in that kind of 2 to 3%. 3%. What's it now in the U.S., John? It's like in around
Yeah, it
three.
just ticked up in June. Yeah. So
Yeah.
the data coming in June, it was closer to that 3%. That's right.
What that means is like between 3 and 8%, depending on the year that it's in. That means that pool actually goes up that following year. That means it's now $108,000, and then the following year it's another. It grows, so you need more dollars to buy the same thing. The other thing is true. If you have $100,000 sitting in your bank account and sitting in cash, you have you see it. It's still showing you 100,000, but a year down the road, you go out to the shopping, you're buying food, and you realize, holy geez, this is not buying me $100,000 of goods and services anymore. It's actually buying
Hmm.
me less. And so this is where we've noticed this in a big way when you go to the grocery store now. It's like, oh my goodness, are they really charging that for a steak? It's like
Yeah.
that thing is like 20, it's like $25 for a steak out there, right? And so this is what happens, is that your dollar doesn't buy the same thing that it bought in the past. And so this is where it's so important that you take that dollar and you trade it for something that it'll go up in value at the same at it'll protect yourself if that dollar's actually value is declining. It'll actually go up in value as inflation continues to happen. And bottom line is we're in a market right now where governments are printing, trillions and trillions of dollars. And so they're continuing to do that. I mean, they just raised the big beautiful bill in the U.S. They just raised the deficit permissible. I think it's like by was it three? It's a massive number, right, John?
Yeah.
In regards to
Trillion,
that,
5 trillion.
five
Yes. Yeah.
trillion. So
5 trillion.
that's
Yep.
a massive
Yeah.
number, right? It's
Yes.
like that's coming from somewhere, and that waters down the amount of dollars that are out there circulating, which just means that it's not buying as much, which is very bullish for assets.
That's right. And the cold hard reality is that, I've seen some analysis that, the government is sort of okay with inflation because ultimately that lowers that debt, right? Because as
Right.
inflation increases, that debt
Yeah.
amount is actually coming down. And so, it's not to say that they're sitting here purposefully doing it, but at the end of the day, like, we have to look out for ourselves in this world, and so, where can we find opportunities that will support our families and provide and create that wealth we're looking for, even in these turbulent times, right? And so, somebody on a fixed income is getting crushed right now, right? Stock volatility rises because ultimately, and I'm seeing it, and it's interesting because, and I'll just use an example. I like to go to this one area of Florida for spring break every year, and generally, if you don't book a house 6 months in advance, there's limited to no options left. And this year we decided we weren't going to go, but at the last minute we said, gosh, maybe we can go down for a few days. It was a long story, but our kids had different spring breaks. All that said, I went on and I was able to choose whatever house I wanted. And I was shocked. And I called my friend who lives down there and he said, oh yeah, it's about 40 to 50% fewer people down here this year than last year. No doubt about it. He lives there. He sees it. There's no traffic jams, no waits at restaurants. And so people are making a decision to spend less money now. And I don't think it's really shown up in the economic data quite yet. And so fewer consumers buying products means, revenues are going to dip for these companies, which is going to create that volatility. And that's why we really love real estate, especially multifamily. It's such a powerful inflation hedge. And the reason for it is that, rents adjust annually, right? So if we have to pay more, say, for a renovation package, we can adjust the rent accordingly to make up for that. unlike bonds or other fixed income investments, right? They're resetting on an annual basis. And, that ability to raise rents, we have to be cautious, right? Because we still want to maintain affordability. But, that ability to grow that net operating income, even in those turbulent times. And we've said this about a million times on this podcast, but the demand for shelter will never go away. It's a core human need. And so when we provide an exceptional product with exceptional resident experience, top tier amenities, and we take care of the residents in a really meaningful, powerful way, they're happy to renew and accept that rental increase because we've also provided them with something of value. So, multifamily resetting annually is one of the top reasons we love multifamily. We're able to control and raise our net operating income even in times of economic turbulence.
Oh, so good. So good. So just a couple of things you said. We want to maintain affordability. That's why it's so important that we're buying in areas where the income to rent ratio is under 30%. So if we do need to raise rents, we're not a market where we're already charging 50% of their income. We're
That's right.
charging less than 30% after we do the renovation and raise it to our perform our projected rental rate. So yeah, if we'll just say if inflation happens and we realize, oh, we need to raise rents, it's still affordable for them. Now, the other thing that's really important here in the markets that we buy in, this is why I'm one of the major reasons why I'm so bullish in the Southeast, compared to especially the markets that have rent control. Like, so for example, in Ontario and Canada, almost half the population is actually in Ontario. So like for if you're American, you're listening, a province is like a state pretty much, but Ontario is like the biggest one. In Ontario, you can only raise rents by 2.5% a year. They have rent control. And so this means that if inflation is really high, you can only raise it 2.5%. And John, here's another story we've shared a lot is, I have a building up there that all the other units were getting $1,700 a month, and there's one tenant that we're only getting $650. And so that's because there's rent control. But the markets that we buy in, we can raise rents to market value. And so this is why investing in an area that has no rent control is extremely important, that you invest in those markets when you're in an inflationary market, to protect yourself. Otherwise, you can't raise rents, right? If you can only
That's
raise
right.
rents a certain amount, and so that then it wipes out that potential benefit of real estate, because you can't raise rents in those markets. And the markets that we invest into, you can. So 100% rents you can raise as inflation increases.
That's right. And one of our golden rules at Faris Capital Partners is we always take down fixed rate debt. So in this kind of inflationary market, our largest expense is locked. We don't have to worry about that cost shifting or changing during our ownership period. So as rent and income rise with inflation, our spread increases, right? Because our fixed rate debt stays the same. So, if you're thinking about investing in one of our deals or a deal with another operator, it's critical you ask that question. What are the debt terms, and is that debt rate fixed? Because in this type of market, you cannot afford to take floating rate debt. It's interesting, Mark. We've even talked with some lenders who try to tell me why, oh, yeah, you rate cap and you do this and all that, and you can still protect yourself. But, if we can qualify and the deal works at fixed rate debt, that's for us. If it doesn't, it's just not. We just walk away. And as we're paying back and we're making these payments, we're actually reducing, right, our principal. So, we're helping to increase the value there as well. And I think a really big one too is that we're buying existing buildings. And so with inflation, the cost to build a new asset increases, right? So our replacement cost in turn increases, right? So materials, labor, all those things are going to go up because, ultimately in a competitive labor market, which we do have in the US, in order to attract talent, you have to pay more, and inflation's a big driver of that. So as the property value gets pushed up through these new construction buildings that are being built, it pulls our existing building up alongside it. So it's not to say a 90s vintage is going to trade at the same as a like-kind 2020 vintage property, but we're still pulling it up, Mark. In fact, one of the things that was interesting for me early on in my real estate career, we were fortunate at Mark Spain Real Estate to attract institutional investors that were buying single family rental properties for rent. And Invitation Homes was our client. They are the largest property owner in the United States. They actually owned 85,000 homes in just Atlanta, and we were selling them hundreds of homes a month. It was an incredible time, and it was during the Great Recession, so we were very blessed and fortunate to have that opportunity. The reason I'm sharing all this is what caught my attention is when they talk about their metrics, they had like 5 or 6 that were super important, but the number one most important was the discount to replacement cost. And we were actually down at 60 Jane, one of our newer acquisitions, Faris Residences Noonan. And I was talking with the contractor that we're getting multiple bids. So one of the companies was there, and he actually worked with Invitation Homes, did a lot of their turns. And we were talking about it, and he said, when they first came to market, he's like, I thought they were smoking crack. He's like, I just could not understand why they were paying what they were paying for these homes for. I thought it was worth 85, they'd pay 120. And he said, boy, was I wrong, because that 120,000 home is probably worth $450,000 today. So it was all about that discount to replacement cost, because they knew once the recession passed, new development would start, it would pull up all those values. So, these big hedge funds, these big private equity funds, I mean, Blackstone's one of the biggest in the world. That's how they were basing their investment thesis, was on that discount to replacement cost. So for us, we really focus on the fundamentals of the building, but that is a metric we do look at because we know it will have an impact on the future value of our buildings.
So good. So good. Yeah. Like you mentioned it here, but I'm going to paint some more context onto paying back any sort of debt that you have with inflated dollars. So the dollar is not worth as much down the road. And so I looked it up. So US right now is $36 trillion in debt. So 36 trillion is what
Yeah.
they're in debt. And so their whole thing is like they have debt payments on that, but because the 36 trillion went out and bought goods and services, and mostly for, there's a lot of frivolous spending in that, but they went and spent it and they bought certain things. Well, they're paying debt payments back with less valuable dollars down the road. And so we can play the same game that they're doing, and banks are doing as well, by buying these assets, getting the fixed debt that you had, so fixed mortgage that you were talking about. And so the rental dollars that are coming in from our resident base, we're actually paying back those debt payments, that loan, with less valuable dollars down the road. So like this is such a strong hedge against inflation, and you win on multiple fronts.
That's right. Absolutely. So, one thing we'll quickly touch on, but, tax benefits stay intact, right? So, that depreciation that we can offer when we're spending that CapEx dollars. So for our Canadian investors, when you get your T5013, it shows, the return of capital you're getting in your monthly cash distributions, but it'll also show your portion of the CapEx that was spent. So often that's just offsetting some of those potential gains down the line, right? In the US, we have the benefit of what we call bonus depreciation, where we can run a cost segregation analysis and break apart the value of the building from the personal property. So US does have some more attractive tax incentives there. In fact, on a more recent episode, we even talked about how that program has been expanded. And so, investors from the US who invest in our deals, if you're listening, you could take 100% of that, depreciation in year one. So major advantages there. And, inflation makes real estate's after-tax performance even stronger for some of those aforementioned reasons, right? So it's just for us, look, I said it earlier, it's all about diversification. And you and I talk to investors all the time, and so many of them, they're so busy with their full-time jobs. They're either owning and operating a business, or they're a high performer in a larger corporation. And, they just simply don't want or have the time to go operate another business, right? Operating a multifamily building or whatever. And so they just stick their money in the stock market and just let it sit there and bake. And, there's strategy there, right? I mean, over a longer period of time, if you look at the numbers, it's like Warren Buffett said, just put the money in. And if you're not willing to hold that investment for 10 years, you shouldn't invest in it to begin with. And I am a believer in that. And I have quite a bit of money socked away in the stock market, but I focus a lot of attention on the real estate side, because once again, to me, stock market is my safety net for retirement. Real estate is my wealth creation vehicle.
So well said. It's like to kind of give final thought on inflation. It's a hidden tax. Most people don't see it out there because it's hidden. And I think that the hidden tax is going to impact more potential retirees than we'd expect. So whatever the number is that you think you need to retire on down the road, whatever that nut is, just make sure that it's high enough to factor in inflation, because a lot of times it's not. And
Mm,
for the prepared investor, it's also, this inflation is actually one of the biggest wealth building opportunities of this cycle as well, if you prepare for it and if you invest the correct way. And some of the insights that John and I shared with you will help you do that moving forward. Thanks for listening, guys. If you enjoyed the show, please share with other high net worth investors that you think will benefit from it. Thanks for tuning into the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.